Matthews is now with us of Bank Julius Baer and Company. Mark, good morning. Good to have you here. Prashant, this side. A rampant confusion about the 2nd April tariffs. Some relief, no relief. Will blanket tariffs, carve-outs, etc., etc. I mean, at some level of obviously, I think it's been a tiring 2 months or so since the inauguration, with at least headline chasing. What's your sense, Mark, as we get closer now to the 2nd of April? Will it be meaningful? Will it be everything on day one? Will it be phased in? What's your sense?
Well, Prashant, you're right. It is chasing headlines, which you're right. That's an exhausting thing. I think there's two ways of looking at it. The one way of looking at it is that they're just kicking the can down the road by coming out every other day, it seems, with little tweaks. So, for example, the most recent one is that there will be flexibility and a lot of countries will get breaks on the reciprocal tariffs, and some of the sectors will not have tariffs applied to them, like automotive and semiconductors and pharmaceuticals. To me, that's kind of kicking the can down the road, because what we want is certainty and what we don't like is the uncertainty. So that's the negative way of looking at it. The positive way of looking at it, though, is last month Donald Trump said that, or he heavily hinted is maybe a better way of putting it, that he didn't really mind if the stock market went down, and maybe there could be a recession as a result of all the changes they're doing. It might be that he actually does care, after all, about the impact on the economy and the stock market going down. Because unlike Joe Biden, who was kind of, out of action most of the time in his presidency, Donald Trump is in the media every day, all the time. It's amazing how much he gets around. And so if the market does turn into a bear market, if we do have a recession, absolutely, he will be the one who gets the blame. Like Harry Truman said, the buck stops here. And so it could be one or the other. I don't know which it is. Either, it's sort of kicking the can down the road, or maybe he actually does care more than we think he does about the market and the economy. But on balance, my feeling is that this is a market that is going to churn for a few more months. There has been just far too much uncertainty created, and we're clearly seeing that starting to percolate through into economic data.
Yeah, but given what they've been saying, of course, some of his close aides, including Mr. Besant, caught the market off guard, saying short-term pain is fine and you have to fix the long-term issues like deficit, etc. So the image that they seem to be creating is that they don't care about the market. Well, we'll find out soon enough, Mark. Now, the question is that as, U.S. equities have been faltering, there's a change, obviously, in terms of the flow picture towards India. Do you expect a much bigger, wider move in the Indian market? Right now, we're just recovering from extremely beaten down levels. But do you expect a bigger India rally to build?
It's not just India, by the way. There's about 50 country ETFs listed in the United States, and 35 of them are up so far this year. So most of them are up, and the world, excluding the United States, stock index has returned about 8%. So India is just one of many countries that have actually benefited from this turmoil and people feeling that they don't want to invest in America as much, at least, as they did before. Many people had pretty much 100% of their equity exposure in the U.S. market before. And I think a lot of it is personal. I don't know if you've been reading about all these people who've been taken aside and detained trying to enter the United States, going through immigration, not just people from sort of Central America or South America, but Europeans, Canadians, being swept up into this strange immigration dragnet. And so, if you don't want to visit a country, you probably don't want to invest in it either. And I think that perception is helping the rest of the world. India, there's pros and cons. The pro is that it is the fastest growing large economy in the world. It will be the third largest economy in the world in a couple of years. So GDP growth in excess of 6%. You don't find many very large economies that have that. That's the pro. And the con is it's expensive. It kind of always has been, but now that it's bounced a little bit, we're back at, around 20 times forward earnings, which is a bit more expensive than the long-term average, actually. The long-term average, if memory serves me right, let's say over the last 20 years, is probably closer to 18 times forward earnings. So on the one hand, you've got great growth. On the other hand, it's not cheap. I don't know. I've always preferred growth over value, and I think that growth deserves a premium. So that's why we're overweight India, and we're sticking with that call. And maybe other people are starting to think that way too.
A valid point, Mark, and good to see you in as always. Mark, what about the dollar index? The perception was that President Trump is going to be very, very good for the U.S. markets and the U.S. economy. Well, in the last couple of months, that's got a little bit derailed. But what's played according to script, like we saw in 2017-18, is that the dollar index, once he took office, we did see weakening out there. And even out here, in this year itself, we've seen the dollar index cool off from around 110 to around 104. How do you see that one moving out? Because from an India market perspective and an emerging market perspective, the dollar index is extremely crucial. Your take?
Absolutely crucial. Well, we've noticed the dollar has broken some very key barriers. It had upward trend channels for the last few years against many of the more cyclical currencies like the Canadian dollar, like the Mexican peso. So it's broken those barriers to the downside. And we generally think that will continue. I mentioned earlier, that a lot of people just don't want to go to the United States right now, and they're not investing as much there. So if the flow of funds is generally in the other direction, of course, that would mean a weaker dollar. And the dollar is very expensive. I mean, if you just measure it fundamentally in terms of trade and Forex reserves and GDP growth, that kind of thing, it is pretty much the most overvalued it's been ever because it had been going up for the previous 4 years. So on balance, I would look for softness in the dollar, and that should be good, as you say, Nigel, for the broad emerging market asset class.
All right, Mark, we'll leave it there. Thank you very much for joining us. Appreciate it. And thank you for being here, as always.